We've covered spreads before, right? So you most likely are used to what a spread is. But what if I told you that there's a different kind of spread that instead of opening two positions at the same expiration, it actually opens one way further ahead in time than the other leg? So let's talk about it in today's video. Welcome everyone. As I said, today we're going to be covering the calendar spread. Well, if you come from traditional finances, especially options traders from traditional finance, you most likely heard about calendar spreads. Well, calendar spreads are very famous because they are able to give you a lot of profit, especially when the underlying asset does not move. So if Bitcoin or Ethereum, in our cases, if they stay close to the current price or they have minimal variations, you can be profitable with the calendar spread. And as I said before, it is a little bit weird because instead of having two options that expire at the same day, so for example, in 1 week or in a month from now, actually one leg is going to expire earlier and the other leg is going to expire a little bit further in the future. Well, why is that? That is what gives the special payout for the calendar spreads. So we're going to go through how to open one, when is it beneficial, and what is the payout for this sort of options. So let's start together. The basics are you open a position, so you sell an option and you buy an option. Both of them are in the same strike. The strike that you choose will be the peak of maximum profit. So if you believe it will stay close to current price, you open at the money. If you believe it will be closer to a price a little bit below, then you go a little bit in the money. Or again, if you believe it will stay at a certain price above the current price, then you go for an out of the money. But pretty much the strike needs to be the same for both legs. So an option is sold at a certain strike. Let's say, for example, $63,000 for Bitcoin. So you sell a $63,000 for Bitcoin for 2 weeks ahead. And then you buy a long option. So you're going to buy a call. You just sold a call. Now you're going to buy a call for 63 as well. So same strike as the one that you just sold, but instead of being for 2 weeks in the future, this will be for 4 weeks in the future. So this is how you build up this strategy. You sell to open a call at a specific strike, in our case, $63,000, and you buy to open another call with the same strike, so $63,000, but for the future, so longer time expiration than the one that you just sold. So in our case, 4 weeks ahead. So you have a 2 weeks and a 4 weeks, one is sold and one is bought. This is how you execute the calendar spread. So Everton, when should you do a calendar spread? When is profitable for me, or what is the best situation that I'm looking for when doing this spread? Well, you purchase a spread like this, a calendar spread, when you believe that the underlying asset will not move or have very minimal movement at the strike that you chose. So if you buy an at the money, for example, right now, Bitcoin is at $62,000. If the strikes that you choose are $62,000, you want it to stay closer to that price. But let's say you believe you will go back to 63.5 and keep it as is. So you choose 63.5 as strikes. This way, you're going to expect that it's going to go closer to the price and stay inside the range. And because these options have different expirations, you open both legs together, but they're not going to close together because the short position will expire first. So best case scenario, because you sold a call, you wanted to, before the call expires, you want it to stay below that strike. You're going to profit from that premium, and then you want it to rise above the call to profit from the one that you bought for the future. So the one that you sold will be the first one to expire, and that one you want it to be below because you sold a call. Remember, when you sell a call, you want the underlying asset to stay below that strike. So that is the first step. After that, you want it to rally a little bit more. Why? Because now you're going to be profiting from the call that you bought. So if you bought this call, you want it to go up a little bit more. So premiums for that option will increase and you can close that option for a profit. Of course, not all the time you're going to hold this position to expiration, but I'm going to show you the payoff in just a second. So best case scenario, you don't hold it all the way to expiration. You hold it after the first leg expires, collect the premium, hold it a little bit more. If there's profit, you close. If there's no profit, what you can do, one of the strategies that you can use is to roll it out, meaning that you simultaneously close this leg and open a next spread right after it. This is called rolling out an option. Well, something interesting is that the initial cost that you pay to open this position, so this is not a credit spread, this is a debit spread, meaning that money is going to be coming out of your pocket to open this position, to structure this position. Well, you're going to pay money, and that is your maximum risk. So if overall you paid $500 to open this strategy, this is your maximum loss. But the maximum profit, that can vary. We're going to show the payoff diagram right now, but it can vary because the payout has different stages. For example, if the first leg of the option, which in our case is the one that we sold, expires worthless, well, now you pocketed that premium, and then the underlying asset rallies, guess what? You have infinite profit that you can take out of it. Well, again, you have a maximum loss, that is the price that you pay to open a position, and best case scenario, you have unlimited profit for that option. What if it's not best case scenario? Then it needs to stay at that certain price. After the first leg sparks worthless, you're still going to have some value in the premium for the option that you bought, which is going to be expiring next. You can close that and pocket that as well. So it's not going to be unlimited profit, but you are still going to get some money because you collected premium plus the price itself that option has for the option that you bought. Now, this right here that you're seeing is the payout for the call calendar spread. You can see right here, it does a little bit of a TP shape, an A shape, whatever you want to call it. And the number right in the middle is the strike that you pick. So here it says 50, but in our example is 63,500. So 63,500, that will be the tip, the most amount of money you're going to make. This is when you close a position right after the first leg expired worthless. Again, if you hold it and Bitcoin actually goes above this price, because you have a call that you bought, it will increase in price accordingly to the price itself of Bitcoin. Of course, there are examples where you can actually collect premium to open this position. For example, on a long call calendar spread, you are going to be paying, so it is a debit spread. But if you short the call, so if you short the call, meaning that you're going to buy to open the first leg, which will expire shortly, and then you're going to sell to open a long expiration leg, you're going to do the opposite of the first example that I gave you. Well, this one, you're going to collect a premium, but guess what? Here, the maximum risk is unlimited because you collected the premium up front. You have maximum risk, which is unlimited. So you don't want to do that. You know that it's there, but you don't want to do that. Now, you also have a long put, which is similar to the long call, but for puts. So you're going to sell a put first, and then you're going to buy a put for longer term expiration. And then you also have a short put, which will be credit. You're going to collect the premium to open this position. But again, just like the short call calendar spread, the short put calendar spread gives you unlimited risk. So why would you want to do that? The premium needs to be extremely juicy for you to risk losing an exorbitant amount of money. So I don't see it working. So if you want to try it out, you should just keep it with the call calendar spread or the put calendar spread, both longs. So again, this could be one of the options that you will be able to execute on Bitopics. We're working on portfolio margin, as I said multiple times before. When we have portfolio margin, what will allow you to do is allow you to open multiple legs together in a bundle. This way you can do these multiple leg strategies together and have it in a single P&L, because you won't have to open two legs separately to have margin for both legs. You're just going to have a single margin for everything. And in some cases, you won't even need margin. For example, like this is a debit spread, meaning that you won't need margin at all for this. Just the amount of money that you pay to open is the money that you will need, and full stop. So these strategies are very good for you to know because they allow you to trade at any market conditions. Again, any market conditions, just like something that you cannot do with futures. For example, with futures, it is directional trading, meaning that for you to be profitable, it needs to go up or it needs to go down. If it stays still, you're going to be losing money to funding fees, going to be losing money to keeping the position open, waiting for something to happen to the underlying asset, which is not the case at all for options. For options, you can be profitable in a crab market, you can be profitable in a bull or in a bear market, all conditions. And I covered some of these strategies before here in the channel. So check our videos out. Make sure you watch all of the tutorials on spreads, on how to earn, how to copy trade here on Bitopics. And if you have any questions, comment down below. So do you want to see any more strategies here that I haven't covered before? Comment down below and I'll make a video about it in the short future. Thank you very much. Have a good day, and I'll see you guys on Friday for another video. Peace.